Basic of bonds. Basic characteristics of bonds. Corporations can borrow money by selling bonds, leverage financing. Bonds are issued with a par value of $1,000. Issuer, parentheses, company, pays interest, parentheses, usually semi-annually, close parentheses, to the bondholder through the life of the loan. Bonds are more long-term, 20-year, 30-year, etc. The interest rate is called the nominal coupon rate and will not change, fixed through the life of the bond. Coupon rate is expressed as a percentage of par value. Example, 5% coupon bond equals $50 per year in interest. PD, parentheses, PD semi-annually equals $25, close parentheses. Investors receive par value of $1,000 back at maturity plus the last interest payment. Maturities. Term. Example, 10 years, 30 years, etc. Entire principal is prepaid at maturity. Serial. Portions of the principal matures at intervals over the life of the bond. Balloon. Combo of term and serial. Repays portion of principal at intervals, but usually pays a larger portion in a balloon payment at maturity. Let's stop and understand bonds pricing. Market forces affecting bond price. Bonds are typically issued for long periods of time, often 30 years, and the coupon rate is fixed, so the bondholder will continue to get the same rate as long as they hold the bond to maturity. But if he wants to get out of the bond, can he cash it in with the issuer? No, he has to sell it on the secondary market. Now, during that time, interest rates in the economy change. So if interest rates go up to 10% and the same company issues a new bond at 10%, then the 5% bonds are not as valuable. So they may be only worth $500 on the open market, parentheses, secondary market, close parentheses. So as interest rate goes up, bond prices fall, and vice versa. They have an inverse relationship. When bonds sell on the secondary market for less than par value, they are said to sell at a discount. When bonds sell on the secondary market for more than par value, they are said to sell at a premium. The longer the bond term is, the more risk or price volatility. Yields and interest rates. Bond yields, nominal yields, parentheses, NY, close parentheses. Coupon rate, state yield, coupon rate, stated yield, set at time of issue, fixed, no change. Current yield, equivalent interest rate the bondholder would receive if they purchased at a discount or premium. Current yield equals annual interest over market price equals $50 over over $800 equals 6.25% or equals annual interest equals $50 over market price equals 1250 equals 4%. Yield to maturity, parentheses YTM, close parentheses. The annualized return bondholder would receive if they held the bond to maturity. Yield to call, parentheses YTC, close parentheses, reflects the overall yield if the bond is called, paid back, close parentheses, prior to maturity. Bond yield seesaw pick. Bond ratings and features. Safety and vitality in bonds. Bond ratings. There are three major credit rating agencies for bond issuers. Number one, Fitch Ratings Inc. Number two, Moody's Investors Service Inc. Number three, Standard and Poor's Rating Service. Ratings: triple A, double A, triple V, investment grade, BB, B, triple C, double C, D, non-investment grade, which are junk bonds and high yield, junk bonds that are high yield. Non-rated. Not all bonds are rated. Issuers have to pay to be rated, and some choose not to. Volatility. The more a bond moves in response to interest rate, the more volatile that it is. Long-term left and lower coupon rates make a bond more volatile. This combination is expressed as duration, which represents the bond term remaining as well as its coupon rates. You will not need to calculate duration. Just know the longer duration, the higher risk volatility. Bond features. Bonds are redeemed by the issuer for par value on the maturity date. However, they can be issued as callable or non-callable. Number one, call feature. If callable, the company can pay off the bond prior to maturity. This is normally done when interest rates drop below nominal coupon rate. The company will pay off the debt at the high rate and sell new bonds at the current rate. For example, parentheses, 2%, close parentheses. Smart, huh? Parentheses, like you're refinancing your mortgage, close parentheses. Issuer usually pays bondholders back a price higher than par, known as a call premium. Put feature. Opposite of the call feature, the investor can redeem or cash in the bond prior to maturity. This is normally done when interest rates rise above the nominal coupon rate. Convertible allows the bondholder to exchange the bond for a fixed, predetermined number of shares of common stock at any time. Zeros to corporate debt. Features of a zero coupon bond. Bonds that are issued with a 0% interest rate are called zero coupon bonds. So, how does the bondholder make money? They are purchased at a deep discount and redeemed for par value at maturity. Types of corporate debt and order of liquidation. Corporate bonds, secured bonds, corporate debt secured by collateral, like mortgage to you, deposited with a trustee, usually a commercial bank. Types of secured bonds: mortgage bonds backed by real estate, collateral trust bonds backed by stocks bonds of a subsidiary corporation, equipment trust certificates backed by equipment such as airplanes, railroads, cars, etc. Unsecured bonds, debentures, not backed by collateral. A debt issued by a company backed by only the good faith and credit of the issuer based on the company's promise to pay, like a credit card to you. A holder is considered a general creditor because there is a higher risk than a secured debt, usually issued at a higher interest rate or with the special features like warrants or conversions privilege. A subordinate debenture is junior to debentures issued previously. Bond features. Bonds are redeemed by the issuer for par value on maturity date. However, they can be issued as callable or non-callable. Call feature callable. If callable, the company can pay off the bond prior